Hi, everyone. I want to thank you so much for joining me and tuning in to this October monthly market report because I know there's been such a great deal of uncertainty and questions and a lot of talk about what have we been seeing happening over the last few months here in real estate. And really, it's not been the last few months, it's been the last couple of years that we have seen a very volatile market. And nonetheless, I know with you've probably heard it, the hikes of interest rates, what's happening to home prices, and where are we headed to in this last quarter after what we have been seeing over the third quarter of 2022. So today I want to share some screens here and kind of just kick off and address some of these concerns so that you have the knowledge and the tools that you need to make those decisions that are best for you and your family. So today, what we want to dive into is we're going to talk a little bit about what's going back through the history of 50 years of what happened in real estate over the past 50 years with interest rates, with home values, with inventory. We're going to take a look at that because it really paints a story of where we are today and where we might be going to. We also want to talk today about the impact of the rising mortgage rates on the market. How will that affect things going forward? I also want to take a look at, we're going to see not globally, but through the US, what's happening in the market. But I really want to take a look at a dive into our local market here, being in the Dallas Fort Worth Metroplex. And then lastly, I want to talk a little bit about where we're headed for and not avoid the elephant in the room, which is the affordability of the market today. So, as I said, let's just kind of dive in to looking at what happened over the past 50 years in the real estate market. So here we're looking at the historical look at the rates, the home values, and our inventory. And as you can see, we're going all the way back to 1971. So over 50 years of data points that we've plotted here on this chart so that you can see that in the red, we're looking at our interest rates. In the purple, we're looking at the inventory. The green, we're looking at home values. And I also want to note here that as you see the grayed out areas, these are periods of recessionary periods because we want to look at how, because there is a lot of discussion about recession. Are we in a recession? Are we headed to a recession? How long will those recessions last? And how will that impact our housing market? So diving right in onto this, we can see the first thing that I really want to show is that back from 1971, we can take a look at home values and say that they've pretty consistently appreciated over time. Now, of course, we do see a couple of dips, right here around 1976, but the biggest dip that we saw over the past 50 years has been right here when we had that big crash of 2008, 2010. And we're going to talk a little bit about that. If you've been following along with a lot of the reports, you've probably heard me talk a little bit about how this market time was significantly different than any other market areas that we're looking at today. Now, I know uh, big thing that's been coming out is rates, and we have seen rates as of this year pretty much double from where they were at the beginning of the year. I want to put your attention right here to all the red, where we were back in 2022 at the very beginning. We were hovering somewhere around 3%, maybe a little bit below 3%, and now we are, as when I did this graph here, they were at 6.7, and today we're at a little bit over 7%, maybe 7.03%. So we've definitely seen a rapid increase in those rates from where we were at the beginning of the year and where we have been over the past 12 years, 10 years, or however long it's been, because we can go back and see that the last time that we even saw rates over the 5% value was back here in 2008, where we saw rates of about 6.21%. So we can definitely say that we have not seen rates like 7% in quite some time in history. Now, I do want to point your some attention to back in the 80s. And if you've heard me say this before, when I purchased my first home, the rates were about where they are today, which was over 20 years ago. But if we look at where rates were back in the 80s, look at the highest amount right there, which was 18.63%. And then they came down, came down, came down, came down, and then went back up, during that 2008 crash, and then came back down. And now we're seeing them come back up. So, where we are today with rates and where we have been, one thing I really want to point out is we have been really spoiled over the past 10, 12 years in having rates that are even lower than 3% interest rates. And that is historically to go on for a period of that long at rates so low has been such an amazing thing, a fortunate thing for a lot of homeowners. And now we're seeing them come back up. And I want to talk about where we're going with that and some reasons behind all of the hikes and rates if you're not familiar with those things. But what I want to point out also, though, is looking at the relationship between the interest rates here in red and still home values going up. Again, I know that we have a couple of times that they've come down a bit, but long term wise, the values have continued to increase despite the interest rates. And I want to show you real quick. I'm going to go over here. If we look at some of the recessionary or the times that mortgage rates have increased for more than 1%, we can see the home prices have continued to appreciate 3%, 2%, 13% during all those rate hikes that we have seen that have been over 1%. Now, this might be a little bit different. It's going to be something for us to keep an eye on because the rate hikes have been drastically more than the 1% just in this year. Now, the other interesting piece of data here that I think is important for us to take a look at is the supply of inventory. Now, if you have been following with me over the times in these market updates, I just want to reiterate again that when we are under 6 months supply of inventory, that is considered a seller's market. We are more balanced market once we get to about 6, 7 months supply of inventory. And then we become more of a buyer's market when we become over that 7 month supply of inventory. So as we can see here, back in the 1971s, we were hovering around somewhere around 4 months supply of inventory. And then we saw them raise up to about 9.9%. And as you can see, there sometimes we are going to see a little bit of a relationship here between when that inventory goes back up to a buyer's market, we can sometimes see the home values start to decline because let's just face it, there's more homes to be chosen and more competitive and the prices coming down. The other time that we're seeing well, as you can see, when we're spiking back in that 2008 period of time, we saw a spike of up to 12 months supply of inventory. And this is another reason why I say that was a different market back in 2008, 2010, when we saw the housing crash. And that was not because of a recession. Granted, it was during a recessionary period, but that housing crash was not as a result of the recession. As a matter of fact, it was the housing industry that really caused that recession and the housing crash. Because if you could just breathe or had a social security number, you were getting a loan for way more than what you could actually afford. So as you can see, 12 months supply of inventory in the history of 50 years, we have never seen 12 months supply of inventory. So of course, what happened with home values right there? We saw a decline in the home values. So one of the pieces of data here that I want us to really pay attention to are the rates where they are today, which we're going to talk a little bit about how that does affect at least one variable in our market, and that's affordability, because we have seen the rates go up at the same time, we've seen a huge spike in our home values, which has definitely had an effect on the affordability of homes, which we're going to address later on. But we also just want to pay attention to where we're at with the month supply of inventory. And as you can see, 4 months back when we were uh, when we were during the first part of the year, the first quarter, the second quarter, we were seeing about 1 month supply of inventory. And I want to point out to you as well, especially for those of us that are in the Dallas Fort Worth market area, look at where our inventory is in relation to the rest of the US. We are significantly lower on our month supply of inventory. And currently we're sitting at about 3 months supply of inventory. So going back to what I said before, still considered a strong seller's market, being that we are still at 3 months supply of inventory. Now, granted, we were at 1 month supply of inventory, which was spiking those home values incredibly at very drastic rates. But again, taking a look at it, which I found was very interesting, looking at 50 years of where interest rates have been, knowing that we have been the lowest that we have ever seen for the past 10, 12 years. We have been since 2000 and since 2011, I think is when we started to see those rates really come down. And they have been that way for 10 years, which has historically over 50 years. We've had 10 years of lower rates than we've ever seen in all of 50 years. So the other thing, again, that for us to pay attention to is our inventory, because we didn't see prices coming down until we spiked, like I said, back into that buyer's market where we're over that 7 month supply of inventory. So inventory is going to be something for us to keep our eyes on as we continue to kind of pay attention and predict what might happen with our home values. Nonetheless, despite the hikes of interest rates, we have continued to see the home values appreciate. So I found this from a First American, and it says that, why is all this happening? Why are we seeing this sudden change? And the aim of Fed tightening is to curtail demand in an effort to tame the inflation. And when it comes to the housing market, the Fed's actions are working. Home sales, both new and existing, are falling. Builders have cut back production in response to rapidly declining affordability, again, which we're going to talk about. And annual house price growth has slowed from the peak of nearly 21% in March of this year to 16.7 in July. Now, I know it's not July, we're in October, and as we continue to have more data on this, we're going to continue to keep abreast of it, and we're going to take a little bit closer dive into the local market. But in essence, what the Feds are doing is exactly what they intended to do to tame the inflation, and that is to decelerate the rate of appreciation on home values, which were skyrocketing and that have become unaffordable. So I know there's going to be some questions about, well, how long is this going to happen? Again, I want to go back though and look at the impact of those rising rates on home prices. And again, as we discussed before, during those spikes of more than 1% of interest rates going up, again, we continued to see the home prices continue to appreciate. But let's also take a look at here the impact of the rising rates on housing, the number of homes that are being sold. And as you can see, there's another direct correlation on the amount of sales. And we definitely are seeing the amount of sales decrease when those spikes of interest rates have occurred. So home prices increase, the sales decreasing. Now, let's take a look also, though. And first, I want to say that, back in the beginning of the year, uh, the forecasters were predicting that definitely we were going to see a rise of interest rates uh, from where we were at the beginning of the season or of the year in the around 3%, sometimes a little bit under, that we predicted that come the third quarter or come the second quarter that we would start to see increases of the interest rates. Now, I don't think anybody predicted where they would be today. So here comes from the realtor.com that while even 2 months ago, rates above 7% have seemed unthinkable at that current pace, we can expect rates to surpass that level in the next 3 months. So that's something that I do definitely want to point out, because I have, now that we are hovering around 7.03 interest rates before you buy a point down, that is that I have heard talks about interest rates expecting to go up even more. Now, I don't want you to think that this is going to be a forever long-term thing. So how long, will this period of time go on? And if we go back and look at that history from going back to the 1980s on those recessionary periods, what we can say is that interest rates during the recessionary period, they do go up to tame the inflation like we discussed, but then they come back down at the end of the recession. So the duration, as you can see, 6 months, 1 year, 4 months, 8 months, 8 months, a year and a half, 2 months, we see that this could go on for a period of 6 months to, a year and a half or so, that we can expect us to get to a point where we're just trying to balance things out a bit and tame the rate of inflation. And if I was to go back to that graph that we showed you right here, we can see these recessionary periods. We can see where the interest rates came up and we can see where they came back down. Again, here we see during the recession of 2008, the hike of the interest rates. And then as the inflation is tame, the interest rates going back down. So there's hope for you guys that are thinking about making that move. That rates might be high right now, but they are expected to come. They could go back up even more so, but over time we do expect those to come back down. And from the birds in the sky that I hear from, perhaps next year at some point, we're already about 6 months in, not 6 months, I'm sorry. We saw the change start happen towards the end of May and June. So if we go June, July, August, September, October, we're 5 months into already this period of duration from the rates. And so hopefully maybe by next year, we'll start to see those come down. So if you're holding off on purchasing a home, just know that you could still, there's so many different options of different loans, and it might be a great time to partner up with a very seasoned agent and a seasoned loan officer to run some equations and make some projections for you, if and even kind of what loan product might be best for you. There's options of balloons. There's, should you refinance once the rates go down? Because again, as we talked about, year over year, we're expected to continue to see appreciation. Now, what's happening here, before I go on to our local market, I just want to point this out again, and this comes from First American as well. While mortgage rates, again, like we just said, are expected to continue to drift higher over the coming months, this is the hope too, much of the rapid increase in the rates is likely behind us. Nationally, while month over month, we're seeing house prices decline, annual house price declines are not expected, given the ongoing supply and demand imbalance and continued strength in the labor market. So, again, going back to the supply and demand equation, we are seeing some decline in prices presently, but year over year, we're going to continue to see them appreciate year over year. So let's go into what is happening here in our local market. And when I say local market, of course, Dallas Fort Worth is a huge market area. So I want to take some of the major counties, being Dallas County, Tarrant County, Collin County, Denton counties, and put all those together. And so we could take a look at what that month over month home values have been this year, starting back in January. So we see the median sales price right here back in January at 316. And what we normally do is we normally will see, some rise, and then we started to see this fall. What I said to you, and I would love to go back to one of my videos that I did in the first quarter where we projected this to happen, which was, if you're thinking about selling this year, it might be good to do it during the first or second quarter, because we did expect things to change over time. So that is what we did see happen. We saw things spike up to May to a median sales price of 371. So then we started seeing things taper and taper and taper, now to where we ended up September with a median sales price across all the counties at $343,000. Now, what I said to you, year over year, although we have started to see somewhat of a decline presently over the last few months, year over year, we're still ahead of the ball game. So this next thing I want to show you here is when we, like we're saying, year over year, taking a look at that, but then looking at each county in its own perspective way. So starting here in 2017, 18, 19, you can see a very moderate, on county to county, slight appreciation. And then what happened in 2020, 2021, and now in 2022, you can see that we well have surpassed what we want to call pre-pandemic appreciation, if you would. And so what some of the economists are saying is that right now we're not depreciating, but what we are seeing is a deceleration in the appreciation, perhaps back to where we were pre-pandemic times. So something to keep in mind there. Now, we want to look at here is, what is the monthly inventory for our counties here in the Metroplex, again, being the Dallas, Tarrant, Collin, and Denton counties. And what I want to point out is that, back pre-pandemic, 2018, and, having been in the business for 13 years almost, I can say that we really have seen a seller's market for probably at least about 10 of those 13 years that I have been in the industry. And we can see in 2018, we were 3 months, 2 months, 4 months. And when I say inventory, let me just reiterate that means that if we're at 4 months supply of inventory, if no other home hits the market, it would take us about 4 months to sell all the homes on the current market. So we saw, back prior to the pandemic, 3 to 4 months supply of inventory. And then what happened in 2020 and about March, we saw that inventory come down drastically around April. To 2 months, then down to 1 month. And in some markets, we were only weeks of inventory that we had to sell, which is why we saw those prices just skyrocket the way that they did. And so we've kind of bounced around between that 1-2 month supply of inventory, even since the pandemic. And now we're seeing that inventory come back up in response to the hike in the rates. Now, where do we think that we might go to? I think it's very possible, and hear me say this, I think it's very possible we could get to 4 months supply of inventory before the end of the year. But again, and hear me say this very clearly, nothing really to be concerned about that I'm too concerned about, because look, we have experienced 4 months supply of inventory. And what did we see going back to that 50 years of looking at what happened with home prices? We saw the home values continue to appreciate. All right. So now one thing I guess, we talked about earlier is what have we seen in the Metroplex, again, the same counties that we mentioned again, with the sales over the past year over year. Let me see if I can move myself around somewhere, since 2018 going to where we are in 2022. And as you can see, month over month, they have been pretty consistent. But what we saw in 2020, that this data, I think, to find interesting, is how right here about April we saw a decrease in the number of sales that occurred. And that's because when we got shut down, the nobody was moving, the closings were being delayed. But what happened ever since then, since 2020, over the months of 2020, we saw them. And normally we're going to see seasonally from January through the end of the year, we start to see an incline in the number of sales through the summer months. And then comes September, we see those drop back out, and then a short incline in the November and December months. So we definitely, what I want to point out is where we are here today, September of 2022, we are certainly seeing a decrease in the number of sales, especially when we compare those to the last 2 years. But if we look pre-pandemic, we're not seeing as drastic of a change that we have been experiencing if we were to go from where we were in 2020 to where we are today. So again, with the home prices, with the interest rates, and with the number of sales, I expect those to balance out. As we mentioned, that's what the Feds are trying to accomplish, and that's what's happening. Now, what is going to happen though with home prices for the remainder of the year? So this is a year over year, and we can see that every one of the forecasters are saying, when we look at Fannie Mae, Freddie Mac, the MBA, we're all looking at some appreciation between 16% on the high and 9.3. And this would be a year over year from 2021. On average, we can see on average 11.3% appreciation. So for those of you, again, that are concerned about what's happening with home values, we are still expected to be at a positive appreciation year over year from where we were in 2021. So let's go to, I don't want to, I know there's a lot of news, a lot of media that comes out there. And of course, the negative stuff is always going to get more attention than what the positive says. But, we can't ignore what Ivy Zelman has said. Ivy Zelman projects that U.S. House prices will fall 4% in 2023, and then another 5% decline in 2024. So I don't want to ignore what Ivy has said, because we certainly do follow Ivy, but I really want to put those projections in relation to what the other forecasters are also saying for where we're going in 2023. And this might help you kind of decide on what you might want to do as for purchasing a home. So if we look at Fannie Mae again, Freddie Mac, the forecasters for 2023, the expectation is somewhere between 4.4 down to 1.2% appreciation. Of course, we have Ivy Zillman over here at a negative 4%. So Ivy is projecting that we're going to see a decline in home values come 2023. But even if we were to average all of these up together, you can see that we have a very moderate rate of appreciation of about 1.8%. So just some good news to look at when we kind of stack up some of the bad news with where all the other forecasters are lining up. I thought that this might be an interesting projection to take a look at numbers. So if we were to forecast though, okay, that's 2023. What about 2024 and 2026? Because remember, Ivy Zellman said, hey, in 2024, we're still going to experience some more depreciation. So, but if we stack again all the forecasters up and we take a look at that, we see in 2024, 86% are calling for a appreciation. Again, 91% in 2025 and 97% in 2026. So longevity wise, again, looking at what we're forecasting for the next 4 years, if you would, is still appreciation. And I want to point out too, if we were to go back up and pull at that graph where we saw for 50 years, what happened? Appreciation, appreciation, appreciation. Now, I know. I don't want to ignore some of the elephant in the room about affordability and how does because even though we are going to continue to appreciate, how is that going to affect the affordability? Where do we stand with affordability today? So let's talk about that. So when we talk about affordability, I thought I found this quote to be important. Compared to from NAR, compared to 1 year ago, the monthly mortgage payment rose to 1944 from 1265, an increase of 53.7%. Guys, that is really, really drastic, and it definitely is affecting a lot of buyers. But one thing that I do want to say, and this comes from Realtor.com, there's no doubt that the increasing mortgage rates will make home buying even more challenging. Buyers may still find opportunities as these changes coincide with the time of the year when buyers have historically found the best market conditions to obtain more bargaining power. And that's exactly right. If you are a buyer in this market and the homes are still affordable, that might mean that you can negotiate for the seller to pay some of those closing costs to decrease your interest rates. Perhaps it's finding negotiating a lower sales price or negotiating repairs. There's lots of things that buyers can take advantage of in this market today to be more to negotiate more and find that affordability a little bit more in their favor. But none the doubt, we are seeing here back in the blue when we had historically years of distressed properties that dominated the market. We could see the prices were so much lower, much more affordable. We've seen that come down over the course of time, and here we are today at about 98.5. So definitely we're seeing it have an impact on affordability, but it also depends on sometimes the region where you are living. And we can see the median household income here on the bar on the left versus the qualifying income to purchase a home on the right. We can see that the qualifying income is a little bit higher than what the median family household income is earning. Now, that does vary depending on your region, but then nonetheless, we can say overall, it is having a slight impact overall across the US on affordability. Well, guys, I want to kind of end right here, and again, just thank you all for joining me today on this monthly market report. Hopefully, this gives you a lot of insight on what's happening historically, looking at what's happening today, taking a look at what's happening in our market, our local market, to help and empower you to make the best decisions that you can when it comes to perhaps one of your biggest assets, and that's your home. Now, I also want to say, hey, if you still have questions, I want you to comment below. Please make sure you're following us on our social media as I continue to keep you abreast on where we're headed to during this volatile market craziness that we're in today. Because again, it's just going to help equip you to make the best decisions with your money and your home. Thanks for tuning in. Until next month, have a great October and a happy Halloween.